Welcome back to the deep dive. Today we are taking a single powerful source document.
Oh, yeah?
It's the opening remarks from the News Corporation, or NWSA, Chief Financial Officer Lavanya Chandrasekhar.
Right after their Q1 fiscal 2026 earnings call.
And we're going to use this to build, well, a complete strategic map of where this global media and data giant is placing its bets.
That's a great source for that.
Our mission here is to really extract the strategic gold. The CFO gave us a pretty clear financial roadmap.
Oh, absolutely.
It outlines some aggressive capital moves and, fundamental shifts in how the company actually earns its profit.
Yeah.
So we want to understand in depth how they're pivoting away from that volatility that has, traditionally plagued these big media conglomerates.
And that's the key challenge they're trying to solve for, right?
Right.
Her statements, they focus so intensely on creating financial resilience.
And evolution.
And executing a complete strategic evolution. They are explicitly shifting resources, toward these durable recurring revenue streams.
So where do we start?
Well, we're not starting with the quarterly numbers. We're starting with the boldest move she signaled.
Which is wood.
How they're using their balance sheet to telegraph massive confidence in their own valuation.
Okay, let's kick off right there with capital allocation.
Yep.
Specifically, that accelerated share buyback program. It was announced last summer, July 2025.
Right.
And this isn't just about returning capital, is it? It feels like a strategic statement about how they see their own stock.
It's remarkably aggressive.
Yeah.
And that aggression, it serves as a very, very loud public signal.
How loud are we talking?
Well, since the last earnings report, the company has been repurchasing shares at a pace of approximately $2.5 million a day.
Per day. Wow.
Per day. And to put that in perspective for you, they are buying back shares at a rate that's 4 times faster than their previous activity.
4 times the pace is significant. But what's the strategic calculus there? Why spend $2.5 million a day and why accelerate now?
So the CFO framed this very clearly as a value proposition. They believe the stock is trading at a, and I'm quoting here, significant discount to net asset value.
So they think it's cheap.
They think it's a bargain. When management is convinced the market just doesn't appreciate the value of what they own, the data platforms, the real estate portals, they see buying their own stock as the best investment they can make.
With the highest certainty of return.
Exactly.
But doesn't that come with a potential opportunity cost? Committing that much cash daily to buybacks means that money isn't going to, say, pay down debt or maybe fund the next big acquisition.
That is the critical question. And they're essentially saying that buying their own stock is a better investment than anything else they see on their M&A radar right now.
Or that they can do both.
Or that their cash flow, their expected financial health, they're getting $380 million from Foxtel shareholder loans this fiscal year. That all gives them enough flexibility regardless of the buybacks.
So it's a calculated risk.
It is.
Yeah.
It's signaling belief over caution. And beyond the balance sheet stuff, she relentlessly emphasized the core drivers of this resilience we mentioned.
Right.
This company is strategically diversifying toward recurring high-margin content licensing and digital revenues. And that shift has, it's effectively changed the company's entire risk profile.
We need to quantify that shift because profound sounds great, but it doesn't pay the bills. How reliant are they still on those old, volatile advertising dollars?
Very little, comparatively. The structural shift is, it's startling.
How so?
Since fiscal 2018, the percentage of the business that's digital revenues has almost doubled. It hit 62% in fiscal 2025.
Okay, that's a big jump.
And here's the metric that really tells the story of that resilience you were talking about.
Go on.
Their reliance on advertising revenue has dropped by nearly 50% in that same period.
Wow.
It now accounts for just 16% of total revenues.
16%. That dramatically explains how the company can stomach macro volatility. They're just structurally protected from that old media cycle.
They're not an advertising machine anymore.
They're a data and subscription enterprise.
Precisely. And that concentration shows up directly in the profits. Look at the segment contribution.
Okay.
Dow Jones and Digital Real Estate Services accounted for a staggering 84% of total segment EBITDA in fiscal 2025.
84%. Up from what?
Up from just 55% in fiscal 2018. That is a massive operational leap.
So the rest of the portfolio, the legacy news and publishing segments, they're now almost peripheral to the core profit generation?
That's the story the numbers tell.
And that pivot didn't happen in a vacuum, right? It had to require some active portfolio management.
Absolutely. They've been very active. We saw them make value-accretive acquisitions like OPIS and CMA to bolster those high-margin B2B data businesses.
And on the other side.
They divested assets that just didn't fit that profile anymore, like News America Marketing.
Right.
And they successfully swapped their stake in Foxtel for a valuable piece of DAZN, which the CFO called the Netflix of sports.
So it's an ongoing process of just simplifying and focusing.
Constantly sharpening the pencil on the entire portfolio.
Okay, let's pivot now to the Q1 financial performance. This gives us a real-time snapshot of this whole strategy in action.
It does.
Overall, revenues came in at over $2.1 billion. That's up 2% year over year. And total segment EBITDA was $340 million.
Up a solid 5% year over year.
Right.
And that jump in profitability drove a margin improvement of 40 basis points, bringing the total margin up to 15.9%.
But the key insight, the real proof that this pivot is working,
is that 89% of the Q1 profits came specifically from those two pillars.
Dow Jones and digital real estate services.
They are the undisputed core value drivers right now.
So let's deep dive into those dominant segments, starting with Dow Jones, the subscription and professional information powerhouse. It continues to be the star performer.
Just another extremely strong quarter from them. Reported revenues were $586 million, up 6%.
And the digital piece.
Digital revenues now account for 84% of that entire segment's revenue.
Wow.
And the growth is clearly being fueled by the B2B products. Professional information business revenues, they rose 10%.
And here's where the high-margin data magic really happens, right? Risk and compliance.
Yep.
This is arguably the most valuable part of the organization because it's so sticky. It's mission critical for their clients.
That's exactly right. Risk and compliance is surging. Revenues grew 16% to $94 million.
And what's driving that?
It's a combination of new customers, new products, and just getting better yield from their existing clients.
Sure.
I mean, when you're selling data that helps financial institutions meet regulatory requirements, those revenues are stable, they're recurring, and they generate extremely high margins.
Because customers just can't afford to switch.
They can't.
And we saw them make a very telling acquisition here with Eco Movement.
This is a perfect example of them looking toward future-proof data needs.
What is it exactly?
Eco Movement is a global platform for EV charging station data. It collects and optimizes data across almost 2 million connectors in over 80 countries.
So very niche, but growing data set.
And this acquisition strategically strengthens Dow Jones Energy, a business which itself grew 7%. They are aggressively buying these future-facing assets to ensure data relevance a decade from now.
Okay, shifting to the consumer side of Dow Jones, what's the story with the Wall Street Journal? How are they growing subscribers in what feels like a saturated market?
The consumer business is still robust, but it's heavily focused on enterprise deals.
Okay.
Digital-only subscriptions grew 10% year over year, adding about 159,000 sequentially.
And Chandrasekhar noted that while these enterprise customers might be, what was the phrase, ARPU dilutive?
ARPU dilutive, yes.
They are definitively margin accretive.
Correct.
That's a crucial distinction. For our listener, can you just quickly clarify the difference between those two terms in this context?
Absolutely. So if a company sells 100 subscriptions to a single bank for, say, $10,000, the average price per person is lower than if they sold 100 individual subscriptions.
So average revenue per user, ARPU, goes down.
Right. But, and this is the key, because they spend $0 on sales commissions or marketing to acquire those 100 users, the profit margin on that revenue is significantly higher.
Ah, lower revenue per unit, but higher profit overall.
It's a very smart shift to higher quality institutional revenue. Digital circulation now accounts for 75% of their total circulation.
Okay, let's move to digital real estate services, the second pillar of that 89% profit share. What's the status of Realtor.com and the segment globally?
Well, this segment delivered really solid results, especially given the uneven macro environment. Softer housing markets in places like Australia.
What were the numbers?
Segment revenues hit $479 million, up 5%, and EBITDA grew even faster. It was up 13% to $158 million.
And they seem particularly pleased with Realtor.com.
Very pleased. It posted a 9% revenue boost. That's its highest quarterly growth rate in nearly 4 years.
Where is that specific growth coming from if the housing market is still tight?
It's coming from strategic growth in what they call adjacencies.
Adjacencies.
Yeah, areas surrounding the primary transaction. Things like new homes, rentals, and seller services. These adjacencies now make up 22% of revenue.
So they're diversifying within the real estate ecosystem.
Exactly, making them less reliant on just transaction volumes.
The audience metrics here tell a fascinating story. It seems to be about quality over quantity.
It does.
Even though average monthly unique users actually fell 6% to 72 million, they emphasized that Realtor.com still had the highest engagement among all the real estate portals.
Right, with almost 5 visits per unique user, according to ComScore.
And that speaks volumes about strategy, doesn't it?
It really does. They are prioritizing high-intent, highly engaged visitors, people who are further along the buying or selling journey over just chasing raw user numbers.
Because if your audience is smaller but more engaged,
You can charge a much higher yield for advertiser placement or lead gen. That focus on depth seems to be paying off.
All right, let's transition to the parts of the business that are facing some genuine headwinds, starting with book publishing, HarperCollins.
Yeah.
The financial results here were, by the CFO's own admission, challenged this quarter.
They were. Segment EBITDA declined 28%. And a specific event really impacted that.
What happened?
There was a $13 million write-off of a receivable pound. It was related to the expected closure of Baker & Taylor,
And they are.
a key distributor, focused predominantly on the library channel. So that hit the results hard.
And outside of that one-time hit?
Well, they were just fighting very difficult comparisons to the prior year. The prior year benefited from major hits that didn't repeat, like the surge for J.D. Vance's memoir and strong sales tied to big properties like Bridgerton and Wicked.
And the general pressure on traditional publishing means the digital side faced challenges too.
Yes, digital sales at HarperCollins actually fell 9%, with audiobooks down 11%.
So even the growth engine is sputtering a bit.
It is, though digital still represents about 23% of consumer revenue. But, and this is important, there's a strong note of resilience in their backlist titles.
Okay, for listeners who are less familiar with publishing, what exactly is a backlist and why is it so crucial?
So your backlist titles are the classics, the established sellers, or just older books that continue to sell year after year. Think J.R.R. Tolkien, or evergreen cookbooks, or famous self-help titles.
The reliable sellers?
Incredibly reliable, and they require minimal marketing investment. Those backlist titles contributed 65% of consumer revenues this quarter.
65%. So that underscores the segment's underlying stability even when new releases lag.
Exactly. And they noted the UK and Christian publishing segments also showed resilience.
Okay, finally, let's talk about the news media segment. This section often faces tough advertising trends, but the profitability story here is really notable.
It is.
Revenues were up just a modest 1% to $545 million. Yet segment EBITDA grew a resounding 67% to $30 million.
Yeah.
That is massive margin expansion. Where did that come from?
It's a classic but dramatic story of cost discipline.
So the top line was flat, but the profit line exploded.
Right. The CFO explicitly credited continued cost efficiencies and structural restructuring. She gave specific examples.
Like what?
Savings from their commercial printing joint venture in the UK and ongoing savings on her top TV business, also in the UK.
But are these savings sustainable? A 67% jump is impressive, but if it's based on restructuring a printing JV, is that a one-time gain, or is this a new, repeatable margin level?
And that's the critical piece of analysis, isn't it?
Yeah.
While some of those initial savings might be non-recurring, the operational discipline has clearly been cemented. That focus on efficiency boosted the news media segment margin significantly.
From what to what?
It rose from 3.3% a year ago to 5.5%.
So they've strategically decided that in a segment with ad headwinds, the path to value is margin optimization, not top-line growth.
Precisely.
Mm-hmm.
They're running this part of the business to be efficient, to throw off cash that can be reinvested into those B2B data assets we talked about.
That sets the stage perfectly for the outlook. Let's wrap up by looking forward. What was the CFO's guidance for the rest of fiscal 2026?
The forecasts really just reflect the expectation that the current winners are going to keep winning.
So for Dow Jones.
They anticipate continued strong B2B revenue growth, particularly from that professional information business and those crucial risk and compliance products.
And for digital real estate.
Realtor.com is hoping for, and this is their quote, continued healthy revenue growth. And management ties that directly to the market's expectation for a reduction in U.S. mortgage rates.
So a macro tailwind there.
Hopefully.
What about the more challenged segments?
For book publishing, they expect Q2 to benefit from better timing of ordering and a stronger front list of new books.
Which should help with those tough comparisons.
It should. And for news media, the focus remains entirely on driving those cost efficiencies. They expect difficult ad trends to persist globally.
So optimize for margin, not revenue growth.
That's the plan.
And finally, circling back to capital spending, they expect strong free cash flow, but capital spending will be up moderately. They're clearly still investing.
They're investing for long-term structural efficiency.
In what?
Well, this includes an investment in new supply chain logistics facilities for HarperCollins, which should deliver additional permanent cost savings down the road.
And technology, I assume.
And, of course, continued heavy investment in tech across the entire portfolio to support those high-growth digital businesses.
And just to tie it all back to where we started, that accelerated share buyback pace.
It is expected to continue. The CFO ended her remarks by reiterating that this high rate of buybacks reflects their strong internal confidence in the company's long-term growth.
And their belief that the stock is still a bargain.
And the continuing belief that the stock is trading at a significant discount to its underlying value. It's a very aggressive statement of faith in their own strategy.
Okay, let's synthesize the most important takeaway for you, the listener. The story here is one of aggressive, really decisive transition.
It is.
News Corp has made a very clear shift of capital and strategic focus toward stable, high-margin B2B data products and high-engagement digital real estate.
And they are structurally minimizing their reliance on that traditional, volatile ad revenue that once dominated their entire business.
So what here is pretty clear?
I think so. They're managing this multifaceted portfolio by balancing huge digital winners like risk and compliance against genuine headwinds in traditional segments like book publishing.
But the future of their profit.
The future of their profit base is explicitly and overwhelmingly tied to high-margin data services and those digital real estate adjacencies.
Yeah.
That is the engine now.
And the rest of the portfolio basically exists to fund it.
That's the way it looks.
Absolutely. So what does this all mean for the long-term structure of News Corp's media holdings?
It's a great question.
Given the CFO's intense emphasis on the long-term value of B2B data, I mean, look at the purchase of a niche platform like Eco Movement and the clear margin superiority of enterprise customers at Dow Jones. Is the traditional consumer side of the business now just acting as a marketing and content funnel for the superior margin B2B products? What do you think? That's the question to mull over as you digest this shift. Thank you for diving deep with us today. We'll catch you on the next deep dive.